Over the past 2 weeks, my trades on EURUSD and the Gear 40 index have brought in about $30,000. You can see them on the screen right now. All I used was context, understanding of liquidity, and smart money logic. And today, I'll show you how it works in practice. We'll analyze the market step by step, where I looked for liquidity, how I determined the entry zones, why I entered there, and what distinguishes a working trade from a random one. Everything will be based on real trades, with real stops, without any fancy cuts. I'll show both profitable entries and those where I've lost money, because the goal of this video is not to show statistics, but to show the thinking process. At the end of the video, there will be an online analysis. I'll show how I approach the market at the moment and what I look at when a setup is forming. I'll say right away, I managed to find several strong entry points that brought in another $12,000. We'll analyze those as well. So if you want to understand how to analyze the market through context and liquidity, watch this video to the end. Let's start with the trade on the Gear 40 index, which was open last week. From the very morning, starting with the Asian session, I switched to a higher time frame and look at the overall movement. We see an uptrend and a liquidity zone, which had already been removed at that point. But the situation remains ambiguous. There are equal highs above, and this is an obvious target for the next withdrawal. Therefore, I continue to observe how the price will behave. I highlight the imbalance zone, which has already given a sharp reaction 3 times. Each time after touching this area, there was an impulse, followed by new imbalances. This indicates that the zone is significant. Therefore, my scenario is as follows. If the price stops within this imbalance and does not break through it, I will consider shorting. If the price went higher, I would already be waiting for equal highs to be taken off. But in this case, we see a stop, a reversal, and most importantly, a fair value gap appears. This is the moment when I start opening short trades. The market has shown that it's not ready to go higher and has begun to build a structure in the opposite direction. It is important to note that this is precisely when the London session begins. It withdraws the liquidity left by the Asian range and triggers a reaction. A fair value gap appears, followed shortly thereafter by a change in structure. This is where I decide to enter. As soon as the price bounces back, I open a trade, the one you see on the screen right now. The trade closed on a stop loss. This is because of my mistake. I set the stop too low and didn't set it for liquidity. This is a moment that you should remember so you don't repeat it. The price did not break the model. I simply set the stop in a zone where it was profitable for the market maker to reach. Next, my trading plan remains the same, so I open another trade. According to my rules, I can re-enter this scenario no more than twice if the model structure remains valid. That was the case this time. The logic remains the same, and I re-enter. After that, the price went down with almost no pullbacks and clearly reached the liquidity zone that I had indicated at the very beginning. The trade closed at the take profit level. As a result, there were 2 trades. The first with a loss of about $4,000, the second with a profit of about $17,000. Both were based on the same model, with the same logic. Mistakes like the one in this trade should be taken as a lesson first and foremost. Because even if everything is perfect in terms of structure and plan, no one can know for 100% how the market will behave at a given moment. And it is in such situations that risk management plays a decisive role. If you have clear rules on stop loss, position size, and number of attempts, even a losing trade will not knock you out of the system. It remains part of your working statistics and doesn't turn into emotions. The market will always provide entry points. The only question is how competently you approach them and how prepared you are to withstand a scenario where it does not unfold according to your timing. Let's move on to the second trade. Again, the Gear 40 index. As usual, I start with an analysis of the higher time frame. This time, we can see how the price accumulates above the area of equal lows. This is a clear liquidity zone that will have to be taken sooner or later, and that is exactly what happens. The price breaks the lows, removes the stops, but it is important that the fair value gap remains slightly below. In my best case scenario, I would like to go long from this area if the market provides the structure. Next, I switch to the lower time frame and see what happens after the liquidity is withdrawn. The price reverses sharply, forms a new upward momentum, an imbalance appears, and most importantly, a change in structure. This is what I am waiting for. We have liquidity, a change in structure, and a fair value gap, everything we need for an entry point. I enter on a pullback in FVG. This time, unlike the previous trade, I strictly follow my system. The stop is behind liquidity. No shifting or moving to break even. This saved the trade. As you can see on the chart, the price returned to the entry zone several more times. If I had set the stop closer or moved it, it would have been knocked out. But this way, everything was done according to the system. The take profit was set in the buy-side liquidity zone. exactly where the movement most often stops. The price reached the target almost without resistance. The result was about $6,000 in profit, but that's not the main thing. The main thing is that the trade was made completely according to plan, with clear logic, entry, stop, and structure. People often ask in the comments, does this logic work on crypto? The answer is yes. A model based on context, liquidity, and structure is equally applicable to currencies and digital assets. Take a look, for example, at the link chart. All the same elements are there. Equal lows as an obvious liquidity zone, fair value gap on the higher time frame liquidity withdrawal, and then FVG, and a change in structure on the lower time frame. And again, the entry point follows the same rules. It's the same logic, just with a different asset. By the way, if you trade crypto, I highly recommend checking out Avidex. It's a decentralized exchange where you have complete control over your funds. No intermediaries, account freezes, or KYC. Just connect your wallet, MetaMask, Trust Wallet, or any other, and start trading. The interface is like the best centralized exchanges. The commissions are lower, and there is leverage of up to 100x for those who are ready to take risks. Convenient, fast, anonymous. I'll leave the link in the description. Now, let's move on to the most interesting part. This is something new on my channel, real-time trading. I'll show you how I analyzed everything in TradingView and then open a trade and follow its development in the MetaTrader terminal. This is important. You will not only see the markup, but the entire cycle from idea to result. Let's start with EURUSD. On the higher time frame, we have a fair value gap zone at the top. At the moment of London's opening, there are two possible scenarios. The first, withdrawal of liquidity from the Asian session at the top, entry into FVG, and short. Or the second one, withdrawal from the bottom, but this option is less likely given how London opened. So liquidity was withdrawn from the Asian session, the structure collapsed, and a fair value gap appeared. But this time, unlike the trade on the GEAR40 index, I did not enter immediately. Why? Because FVG and liquidity are too close. It is in such situations that oversweeps often occur. Therefore, based on my experience, I decided that it would be better to skip this trade or wait for another liquidity withdrawal and entry from the imbalance of the higher time frame. That's exactly what happened. The liquidity was withdrawn again. The price entered the zone of interest of the higher time frame. A new FVG was formed, and that's when I opened the trade. And here we have an oversweep. This also happens. The trade closed at the stop, but the model was not broken. The structure remained. There was momentum, and after a few minutes, another FVG formed. This is already the next entry point, and this is where I re-enter. Next, you will see how everything developed in the terminal. So, as I said, this is where I open my trade. You can see that the order is open, and the stop and take are set. Then the price starts to move down. Everything is going according to our scenario. I set the take profit at the nearest target. The risk-reward ratio was 1 to 2. Why not further? Because New York is about to open, and that means another liquidity grab is possible, but this time from the London session. So I decided to fix the profit in advance. Now you can see for yourself, the price has almost reached the take profit level. The final result of the trade is shown on the screen. The result, the first trade, stopped $2,000, the second plus $5,000. Now let's move on to the GEAR40 index, also in real time and on the same day. The work is again taking place during the London session. I start with an analysis of the higher time frame. What do I see? Two fair value gaps, one above, the other below. Both can provide entry points if the liquidity zones are withdrawn in advance. In London, the price withdraws the liquidity of the Asian session, but does not continue to fall. It simply turns upward. At this point, I did not open a trade. I just watched. I was curious to see if the price would reach the upper imbalance zone in order to withdraw liquidity from above and look for a short position from there. That's exactly what happened. Now let's move on to the terminal. I open a short trade. You can watch how it develops, and I will explain my logic behind the stop. We are in the middle of the London session. I set the take profit at a deeper liquidity zone. I was counting on a movement in several stages, but since the New York session was about to open, I understood that London liquidity could be overswept. So I set the stop a little further away, maintaining a risk-reward ratio of 1 to 3.5. This decision ultimately paid off, and the very next day, the price closed at the take profit level. As you can see, everything happened right before your eyes, from analysis to opening a trade and the final result. Such trades require experience and years of practice. But if you want to trade more easily, start with the OWL indicator. OWL smart levels are not just signals. They are one clear entry point at the right moment. You just open the chart, see the entry zone, stop and take profit, and enter the trade. No magic. Everything follows the trend. Important, OWL is not related to liquidity or smart money. It's a different approach, working with the trend with clear risk. It works equally well on crypto, forex, and the stock market. And to get started even faster after purchase, I will send you the OWL Helper, an expert advisor that simplifies entry and automates the calculation of stops and takes. The link to the indicator is in the description. To get Owl Helper, just message me on Telegram. Hi, send me the Owl Helper Expert Advisor. I purchased the indicator and the date of purchase. As you can see, everything I showed you today is not a coincidence. It is systematic work, understanding the context, liquidity, and logic of price movement. I'm not trying to show perfect trades. You've seen both profitable and unprofitable ones, because the goal is not to look infallible, but to convey the mindset that allows you to develop as a trader. If you've watched up to this point, it means you're really interested in understanding the market, not just chasing signals, and that already sets you apart from the majority. There are many more videos to come. I will continue to analyze real situations, show trades, strategies, context, everything that really works. So if you found this useful, please like, subscribe, and write in the comments what you found most useful in this video.